Hello everyone, welcome to Chill Deal Trades, where I analyze the market so you know what's going on. Today we're going to be doing another video on Chinese stocks and the Chinese economy and markets, and figure out if it's finally time to buy, what the recent news might mean for stocks, as well as what's really happening in the Chinese economy, and is it going to die, or is it a really great opportunity? If you're here and you haven't hit the sub button, please go ahead and smash that and join the squad. The goal is to get to 500, so please help me get there and help build a community. And I want you to comment if you like this kind of content. I usually do the more big picture content on the weekends. If you like this compared to the more intricate swing trading, please tell me so I can do more of this content. But let's jump into things. So the first thing I want to look at is the Chinese economy overall. Is it good? Is it bad? Are we seeing red flags? I mentioned a little bit in my last video. Go watch that one from 2 weeks ago. I'll put it in the description as well as in the upper right corner right now. But let's look at the growth. So the one thing that you have to realize is when it comes to markets and the world, basically, it's essentially US versus China. It's been that for a long time. But the one thing to highlight about China is they've been growing at basically like a 15 to 5% rate of growth, basically since the 60s. They've been significantly outgrowing when it comes to GDP, the US for a long time. And what that growth has caused is for China to catch up to US as a GDP, as a country, quickly. But really interestingly enough, we are seeing that the GDP is slowing. Basically since 2012, we've seen a bit of slowness. On average, I'd say maybe China's GDP has been growing about 10%. And from 2012, we're seeing somewhere between 7-ish to 5%. So that's a really big decrease. And so this is the basis of why I think the CCP is making the decisions they're making. We see growth slowing down. They need to stay above the US growth rate if they're going to continue to catch up, because that's the main goal for China. They want to catch the US. They want to be a bigger economy than the US, and they're going to make decisions to make that happen. And that's why I think all of these things have come out. The Chinese economy has become much more tech focused, and their middle class has grown. And so for any, I would say, successful economy, you typically need a very healthy middle class. And what we're seeing from the numbers, the middle class consumption is about $7 compared to US $4. The middle class is growing and has a lot of purchasing power. But what you also have happening is you're having big companies like Alibaba become monopolies. And so when you have monopolies and you have a growing class, a growing middle class, and you have a growing tech industry, the monopolies can stagnate growth. And the reason that is let's bring up this article here. This was an article a while ago, but Alibaba was punishing businesses for not selling their products exclusively on Alibaba. So to put that in context, say you're selling a product to Amazon's like, you can't sell your products anywhere else. That's what was happening. And so these are the type of things that the CCP is going after. They're trying to increase competitiveness in their market. As the Chinese tech industry grows rapidly, as it has been over the last, I would say, since the dot-com bubble, 2000s, they have big companies like Alibaba, Tencent, Baidu that are essentially monopolies and own way too big of a percentage of their markets. And so the CCP are continuing to make decisions to help stir competitiveness. Because when you have a middle class and economy that's spending a lot of money, you want them to spend a lot of money everywhere. Because when you have 2 or 3 companies hogging all of the growth, it has a negative impact on your GDP overall. But when you're able to spread that wealth to more companies, obviously you're still going to have the backbones like we do in the US, the Amazons, the Googles, but you need space for other innovation to accelerate and grow. And that's why China's making their decisions. It's super bullish. Everyone's scared in the markets. Some of the Chinese stocks are down 60, 70, 80, 90%. But you have to look at a big picture. This is extremely healthy for the Chinese economy, because what they're doing is they're creating competitiveness, and competitiveness is going to keep their growth rate higher, and that's going to stimulate a healthy economy in the long term. Short term sucks, but when things are down 50, 60%, what that looks like to me is a great buying opportunity. So these are things we want to pay attention to. I talked about this in my last video a little bit, but I want to dive a little bit more in to say, hey, guys, don't worry, don't panic. These regulations are good. And what you have to realize is the CCP, they can make decisions quickly. In the US, we have a different government structure, so things take time and years to happen. You know, like if you don't know this or not, there's a lot of talk about Google, Apple, all these companies splitting up. But this is taking years to develop. The CCP can make decisions instantly, and that causes really drastic reactions. But in the long term, these are extremely bullish for the Chinese government. And to kind of, back that up, we're seeing record inflows on these pullbacks. If these things were happening and it was really, really bad or harmful in the long term for the economy, why would people be buying in to these ETFs? The two ETFs I would say you want to look at is KWEB, which is the tech ETF for China. The second one is MCHI, which is, I would say, more of like an S&P 500, for the Chinese market. But we're seeing record inflows on this pullback. This is very, very bullish. It doesn't mean we're at a bottom. It doesn't mean that they're going to go up from here. There could be more downside. There could be years of accumulation and sideways action. But regardless, we're seeing record inflows, which is very, very good. That means people are saying, we understand it sucks. We understand that, a lot of people have lost money. We've even maybe lost money because we owned KWEB at a higher price, but we're still bullish on the Chinese economy long term. And as I mentioned, everything they're doing is to set up that long-term success for their economy. Again, very similar to the last with the inflows, but we're also seeing in mainland China, we're seeing a net buy from people on the Hong Kong Stock Exchange. And so a lot of selling over the last month or so, but we saw a green day this last week. And so we're going to have to see if this continues. Whether it does or not, and if it goes down more, it just creates more opportunity to buy shares. But we're seeing more optimism come in, and record inflows come in, which is very bullish long term. The last thing I want to cover is just news from the U.S. because the U.S. has not been, I would say, hasn't had a lot of retaliation from all the crazy things that the CCP has come out with over the last month. But we did see two things. One, we saw the US say no more Chinese IPOs, which is a really big deal. The second thing is, when we do let you have IPOs again, we're going to have new disclosures that are necessary. And this is really important because, one, it's a really big retaliation from the US, and China has not retaliated yet. And so we're going to have to see where this goes. And this is why in my last video I said we're in the fourth quarter. The fourth quarter is the most dramatic, it has the most news, it has the most volatility. And we're going to be in this fourth quarter for a while. It could be months, it could be years, but who knows? But it's gonna keep going. And so those are things you want to look out for: is how the CCP retaliates, and if the U.S. keeps coming out with more news on restrictions or certain disclosures that are necessary for these Chinese stocks on the U.S. market. The last part of the video, I just want to talk about the KWEB and chart it, as well as the MCHI, because I talked about them. And so personally, I'm not a financial advisor. I bought into KWEB on Friday. And the main reason I did is because this thing is down 60%. As I said, I've been doing a lot more research on the Chinese economy, the markets, what I think. I've been bullish on them for a long time. I think since studying economics in college, with all my professors being very bullish on them and their reasons why. But I've come up with that own analysis on my own. And so this is why I think this is a great position to start buying. I'm not saying put your whole life savings into these, but start accumulating shares. Whenever you buy something, you don't want to buy all your shares at once, especially something long-term. You want to start acquiring shares. And so on this 60% dip from the peaks, maybe start considering buying a few shares. More technically speaking, let's look at some things. So part of the reason I bought is this is the weekly chart. I wanted to look more big picture. On the weekly chart, RSI is at 23. That's so overbought or sold. I don't know if we've ever seen that low of a reading. Last time we saw the reading was this 2008-9 shenanigans that happened. And this is the only other time we had this reading so low. Does that mean the stock's going to just go back up? It doesn't mean that. But these are prices, these are levels that I like buying at. To start accumulate shares. Remember, I'm going to keep saying this. This is to accumulate shares. I'm buying my first portion of shares in these things. You got to come up with your own strategy, but something that I like to do is buy things in fourths. So say I want to eventually own $100 of this. This is not a great example because it's $48. Say I want to own $1,000 of this. I'm going to buy $250 at a time. I'm going to buy it now. If it goes down 5%, I'm going to buy another $250, then another $250 at another price. That's how you want to start thinking about buying into positions for the long term. But yeah, I saw that super oversold. I did some Elliott wave analysis, and I don't know if we're in a fourth or a fifth wave. A fifth wave kind of spoke that this was the fifth. I think that's less unlikely. I think we're looking like we're more in the third, and we still have a fifth wave potentially coming. But the main things we're going to want to see is if we get over $65, and that disqualifies that. But that's quite a ways to push, and we have this really strong trend line. So I could see us coming up to 200-day, reversing off there, and maybe putting in a lower low. Like I said, things are very dicey right now. There's a lot of negativity, but we'll probably get a little bit of, get these out of this really terrible oversold range, pop up a little bit, maybe go lower. And I don't know that. That's why I bought now, because I don't know where it's going, but I like buying this 60% all the way down. When we look long term, we want to look at support and resistance. The 200-day, this is going to start curling down a little bit, and it's probably going to head to this really important resistance range. When we look in history, look at this. This is such an important zone. It's going to take a ton of volume and a ton of bullishness to get over that price, and that's why I think we might hit a fourth wave there and head lower, potentially. Or maybe double bottom here. One of the two. But this is something we want to look at. If we do end up breaking under our 3 wave, which is I think was around $45, when we zoom out long term, we have a really big consolidation between 36 and 45. So if it comes in that zone, this is where I'm going to be considering buying some more shares if it goes lower. And then if for some reason we get just a lot of bearishness, we have a ton of accumulation back here, back from 2014 and 15, which is between 39 and 31. And so those are the two accumulation zones I'm going to be looking for if it pulls back farther. And I think personally, those are zones I would consider buying, but I'm not your financial advisor. The next one I want to look at is the MCHI, which is, like I said, kind of the S&P 500 equivalent, is a way to think about it. And so here, very similar. This is why I thought that we're still in the fourth and fifth wave, is I also saw a very similar pattern here. And those two ETFs are probably going to mimic each other pretty closely, because a high portion of its tech. What we're seeing happen is more of a macro issue with happening in Chinese economy, so they're going to move somewhat similarly. I personally have not bought this yet, just because it didn't sell off as much. This is down, I think, more like 30 to 40% compared to 60% with KWEB. So that's why I bought into that one. And I'm more bullish tech because I think the Chinese economy is pushing more and more that direction. And the way they're going to accelerate growth, as the U.S. has, is make more investments in technology. And that's why I'm more bullish for tech in the long term for the Chinese economy as the primary growth for their economy. But what we see here is we saw a bounce off 200-day, which was pretty bullish. So we'll have to see if this price can get above 76. If it gets above 76, then we actually already finished a fifth wave down, and then we could potentially see sideways action or move up from there. So there's things I'm going to be looking at, but we have this trend line, so I'm going to look for an eventual bounce off of this trend line and potentially heading lower to a fifth wave. In terms of price targets on the way down, I wonder about a monthly chart here. Let's see what a monthly 200-day is. Nope, don't even have that. Let's not even start that. But support zones are one, obviously the 200-day, and we can just see there's so much accumulation and past resistance there. So if we break that, that's for sure going to push a log negative pressure lower. And I'm going to look at this consolidation zone right here as a bottom if we do go lower, which is between 61 and 54. And that's where I might consider buying into the MCHI as well. But that's just a little bit of analysis on this, things to look for, things to watch out for. If you made it this far, I really appreciate it. Thanks for watching the whole video. You guys are the all-stars for watching these 15-minute videos. And please comment, like, and subscribe because I'm really curious what you think about Chinese stocks and the Chinese economy. But that's all I have for you guys. I'll be putting up another video tomorrow covering the U.S. markets. And then I have a stream tonight and tomorrow. I'll put the link in the description on Twitch. Come hang out with me there this weekend at 7 p.m. West Coast time. But I'll talk to you again, guys. I'll talk to you guys again soon.